The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, and welcome to the next big thing in the pension market, Liability Settlements webinar presented by Dietrich and Associates. I'm Krista Dietrich, and I'll be your moderator for today. A few items to keep in mind before we begin. Please use your question box to send questions to me, which I will field to Jay. We will attempt to answer all of your questions throughout the webinar, but we ask that you please try to save them until the end of the presentation for our question and answer session. If you would like a recording of our webinar today, instructions will be emailed to you tomorrow. I'd like to introduce our presenter of today's webinar, Jay D'Annunzio. Jay D'Annunzio is a senior consultant at Dietrich and Associates. His work is focused on developing new business opportunities in addition to delivering client consulting to organizations who are committed to evaluating, monitoring, and executing pension risk transfers. Prior to joining Dietrich, Jay spent over 10 years working within the group pension business units of two leading insurers who have manufactured pension risk transfer products. Jay has also authored several pieces of pension risk transfer thought leadership, which has been published by leading industry trade publications, including Pensions and Investments, Plan Sponsor Magazine, and Institutional Investor. At this time, I'd like to turn the presentation over to Jay.
Thank you, Krista, for the very effective introduction and for agreeing to be my moderator for today's presentation. Also want to thank the more than 150 people that registered for this event. An incredibly diverse cross-section of different stakeholders who collectively are all working in some capacity in and around defined benefit pension plan programs. Mixture of human resources folks, corporate finance folks, consulting actuaries, investment advisors, ERISA attorneys, a really rich cross-section of folks that are all working in the marketplace in different ways. I think that's really reflective of the business that we have here at Dietrich and Associates. We're a firm that specializes in helping pension plans transfer risk and annuitize pension obligations as part of the settlement process. And what that means is that we're effectively complementing all of your work. So it puts us in a pretty interesting perspective to guide this discussion today, which I hope you guys will find useful. But I'm humbled that in this day and age, in 2012, when there's so many people trying to do webinars, that you all found it a good investment of your time to jump on this event. So looking forward to a robust discussion here today, but wanted to kind of warm up the crowd a little bit here. And before we dive in too deep, we wanted to start off with a poll. All the webinar gurus say that if you're going to do an effective webinar, you need to use this polling capability to try to raise the level of engagement. So we're not going to go against the gurus. We're going to do exactly what they tell us to do. So we wanted to think of a question that might be interesting, and we think we have a question that actually has implications that will affect everyone on this call here today. So now that we've baited the hook, Krista, why don't you go ahead and put up that poll question for everyone?
Sure. Got about 60% voted right now.
All right, so want to figure out where our reds and our blues are. For those of you that have been living under a rock, there's a presidential election about to come up here in the U.S. So without directly addressing my own political views, I think as the moderator, I owe you a little bit of transparency here. I guess I'll say I found the comment earlier this week around horses and bayonets to be pretty interesting. Let's just leave it at that. But where do the allegiances of our audience lie, Krista?
We've got about 78% voted, and we've got 53% with Obama and 50% with Romney currently.
Okay.
So I'll go ahead and just publish that. Looks like everybody who's going to vote voted. And we are good to go. So
All right.
53% Obama right now.
Okay. Well, if Romney gets elected, he'll be throwing out Bernanke in 2014 when his term ends, and perhaps the quantitative easing that's been so painful for pension liabilities will start to reverse. But without any further ado, let's jump into today's discussion on pension settlements. And some context here to tee up the discussion. We think it's a very relevant time to be having this discussion in the marketplace, because if we reflect on 2012, there were lots of interesting things that happened throughout the year, but most notably probably pension funding relief reform, MAP 21 to those of you on the call who know it more technically. But we think 2012 is sort of the beginning of a tipping point, at least in the settlement marketplace. There's some things going on in the marketplace that indicate to us that perhaps there's a bit of a paradigm shift beginning to happen in terms of how companies view pension risk and the role that settlements may play in managing pension plan risk on a go forward. So I'd say the backdrop for this entire discussion here is framed largely around the private sector pension marketplace. So those 30,000 or so private DB plans that collectively encompass $2 trillion in assets. I think it's somewhere around 50 to 60% of those pension plan programs are now hard frozen with no more benefit accruals. So that's the group that we think settlement is going to start to become a much more purposeful discussion for. So the first slide here is really just framing up a pension settlement, and it's effectively discharging all or a portion of an employer's pension benefit obligation, right? So we think frozen plans are the plans that are going to need and want to be doing that. Managing a wasting trust is something that, you know, most frozen DB plan sponsors sort of acknowledge that it's not really a question of if, it's more of a question of how and when. From a how perspective, it's the two green boxes in the middle. You purchase an annuity from an insurance company, or you offer a voluntary lump sum which a participant accepts. Those distribution options meet the formal definition of a settlement. Those criteria are on the far left. They're irrevocable. They relieve the pension benefit responsibility, and they eliminate significant risks associated with the obligation. So the how, the purchasing of the annuity or the issuing of the lump sum, are relatively straightforward. The when to settle, I think is decidedly more complex. And I think it's something that a lot of plan sponsors struggle with. Certainly in the environment that we're in today, with interest rates at historical lows and, you know, some pretty significant unfunded pension liabilities existing in these programs. The when, you know, the issue of the when is that in order to settle, you need to recognize some pretty significant added costs. And that's what I think gives companies some consternation in figuring out how much money they're willing to pony up in order to dispose of these obligations. So I think the cost is a hurdle for companies that they need to get comfortable with and need to become educated around. The other issue, it's a little more subtle, that I think challenges the when to settle, is something as simple as the fact that, you know, the decision to settle is really a deviation from business as usual in terms of running the pension plan program. So that in and of itself, needing to overcome the inertia of continuing to self-fund and continuing to issue benefits from the plan trust and continuing to use you know, investment managers as the engine that drive the pension plan program, breaking out of that mold is sort of a psychological hurdle that I think companies need to come to grips with if they're going to wrestle the issue of when to the ground. So wanted to tee up settlements, you know, broadly. We have a bunch of other slides that will drill into other elements of the calculus here. And without any further ado, let's move to the next slide. lump sum versus annuity. So we staked out in the earlier slide that those are the two effective mechanisms for settling the obligation. So we wanted to have a slide that would compare and contrast those different options. And we try to do it graphically here. We'll have to tip our cap to the graphics person here, who's trying to support this discussion with the big check, representative of the lump sum, and the many smaller checks, which are designed to represent the annuity. And I think many of the points on the screen here are fairly straightforward. Don't feel the need to get into all of them per se. I do think there's a couple under each that are a little bit more interesting and nuanced and probably worth speaking to. On the lump sum side, I think it's important to understand that lump sums need to be actively elected. So generally speaking, when a lump sum is offered, it's a voluntary lump sum that a participant must agree to accept. The notable exception would be small benefits that can be cashed out administratively per a plan provision, but generally speaking, a participant needs to actively elect a lump sum. So that's an interesting added step or level of complexity that needs to be considered when thinking about if lump sums are an effective mechanism to help support settling plan obligations. On the annuity side, I think it's sort of the flip side of that coin. It's the fact that annuities are the default. So if somebody doesn't make an active election, the default is, again, if you're looking to settle that obligation, and typically this happens in conjunction with a plan termination event, you need to go out and procure an annuity for that person. So there's some interesting differences there that I think are important to raise. Lots of other things on here that I think are a little bit more obvious to folks. The fact that annuities tend to be a better option for healthy folks. Lump sums, better option for folks that aren't as healthy. Annuities tend to be a better fit for paternalistic sponsors. Lump sums a better fit for plan sponsors that may be more focused on bottom line cost efficiency. But I think the biggest difference between these two, and they're pretty fundamentally different options, is the fact that the annuity provides lifetime income and the ability to not outlive the annuity income. And so that protection against longevity risk, I think, is really interesting. And longevity risk, I think, is something that probably doesn't get a ton of attention. Certainly here in the U.S., there's some larger, more prevalent issues of folks not saving enough, and that sort of trump this issue. But in order to bring longevity risk front and center, I wanted to mention kind of an interesting data point that I came across in Institutional Investors' recently published Guide to Longevity Risk Management. There's a foreword in that journal that actually talks about some stochastic longevity analysis that was done, trying to get at longevity risk and trying to put a frame around it. And essentially what the analysis shows is that there's a 1 in 100 chance that the average pensioner in North America and the UK lives 4.7 years longer than expected. So a 1% chance that folks live 4.7 years longer than expected, and that risk, if you will, equates into $1 trillion of losses in terms of the present value of unexpected additional payments. So $1 trillion of losses, this is sort of the elephant in the room, is longevity. It's sort of an embedded value within the annuity, but we think in the years ahead, longevity is going to become a lot more front and center in terms of a risk, and we think annuity products are going to provide fundamentally different value as more research, analysis, and education takes place in the longevity risk market. But to close out this slide, I'd say these are two fundamentally different options. One of the big differences here is that the guarantees for the annuity actually cost, they're not free. There's some pretty significant costs associated with those. So we'll get into those in some of the next slides.
Jay, I got a quick question before you
Sure.
move on. A question that I know a lot of our clients frequently ask is, what sort of election rates might a company expect if they offer voluntary lump sums to their terminated vested participants?
Okay, so good question there. I think we're seeing a lot of activity in the marketplace around companies doing these lump sum windows where they go out to the term vested group outside of a planned termination event and offer lump sums. And I think I've seen some data recently that says when companies do that, offer a lump sum window, the election rate is about 50%, which is fairly contrasted to the probably 75 or 90% election rate that you see if and when you offer that same term vested group a lump sum in connection with a planned termination event. So in terms of what drives that, I think there's a couple things. I think you know, the quality of the communication effort is certainly going to have a factor into the election rate that you get. I think the specific people that are making the decision in terms of, you know, what's their age, are they more near retirement, do they have a larger benefit that has some embedded subsidies, are they sophisticated? All these things can ultimately drive election rates, and it can be somewhat difficult to precisely predict what the election rates will be far in advance of actually going through the process and soliciting folks and seeing where the process comes down. But a good question, and one that I think we'll hit on more as we move through the presentation. Settlement costs by employee group. So this is the first of two somewhat analytical slides, if you will, where we throw some numbers at you. We wanted to show some estimated costs of settling the obligation through both annuitization and through offering lump sums, broken down by employee group. So in the green, we're showing retirees. In the blue, terminated vesteds, and in the yellow, in the orange, the active population. And I think the caveat here, we've sort of noted it down below, is that we're making some assumptions to be able to kind of present this slide to you. I think in actuality, costs will vary based upon the lump sum and annuity rates in effect at the time of settlement and in the specific demographics of any one plan sponsor's group. But for discussion purposes, I think this does frame up the high-level costs that one might expect to see across these different groups. And really what we have showing here is that generally speaking, you issue lump sums at something pretty close to par, or you can cash people out at about 100% of that liability and how it sits on your books, either from a funding or accounting perspective. It's a bit of an oversimplification, but for all intensive purposes, probably an effective way of looking at kind of the efficiency of a lump sum. On the annuity side, you'll see costs ranging from 110% to 125% of the liability. And again, I think that premium reflects the insurer costs for things like investment management, risk charges, administrative expenses, and the profit, right? The fact that private insurers are managing these obligations as a business and to provide a return that drives their business. Again, I think one of the big risk items on the annuity side, to echo something that we just talked about, is the mortality risk. Right? Not knowing how long people will live is one of the big risks that insurers have to manage against. There's a pretty big gap here between, retirees are a little bit more efficient at 110, the actives a little bit more expensive at 125%, so a 25% premium for that active group. If we drill into that, I think the retirees have already made an election, so there's a bunch of unknowns that are taken out of the equation. On the active side, the insurer is forced to sort of try to figure out, how much more service will accrue? When will the participant actually elect to commence? What form of payment will they choose? You put all those through an insurance company pricing actuary's model, and there's just a bunch of risks there that they need to charge for to protect against the fact that they may not get it right. So that's what drives that higher cost for both the term vested and active group. But generally speaking, you know, your actual plan termination or settlement cost is going to be a function of the numbers that are on this slide here and how they apply to groups. So do you offer lump sums? If so, how many people take them? How many people default to an annuity? All that stuff is ultimately going to drive your total cost. On the far right, we put a bunch of things that play into this discussion. Again, election rates, as we talked about. Anti-selection is something that's starting to pop up as more and more plan sponsors offer lump sums to retirees. It's creating the risk for insurers that they may be selected against, and that all the healthy people will flow into the annuity market, all the less healthy people will take lump sums. So that's something that we're starting to see. We're watching that closely to see how insurance company underwriting evolves in the years ahead. But lots of stuff to think about as we reflect on this slide and look at a variety of different costs that might apply to settling pension obligations. And it looks like we have another question here coming through, Chris.
The question is it better for a company to begin the settlement process by offering lump sums to terminated vested participants or by purchasing an annuity contract for retired participants?
That is a very interesting question and insightful as well, if I'm reading into it correctly. What I'm hearing there is sort of implied that settlement can and perhaps should be decoupled from the plan termination process. And that is certainly a best practice, something that we recommend plan sponsors understand and consider. We think it's an oversimplification for plan sponsors to defer settlements until they wrestle the economics of a total plan termination to the ground. So I have to applaud the question in general. More specifically, in terms of an answer, is it better to do lump sums for TVs as a first step or annuitize retirees? You know, I think that is always going to be plan specific. It's always going to depend on the specific objectives, priorities, strategies of a company. The specific people that are involved making the decisions are going to kind of drive that to a certain extent. But I think it can go either way. I think you can make pros and cons for either strategy. It's just a function of understanding what those are. I will tell you that we've worked with several firms who have actually annuitized their retirees outside of a plan termination merely to streamline the pension program. So they have, and when they get done with that, they feel pretty good about the fact that they've dramatically reduced the complexity of what they're trying to manage. So they took a look at the numbers, they got comfortable with the cost, and they decided to offload the retirees because they understood it was a function of where they ultimately wanted to go, and the economics worked, so they went ahead and closed out that group. There's other situations we've worked with clients where they're beginning to embark on the plan termination process, a process that can typically take 12 to 18 months, and companies have decided that at the beginning of that process, it makes sense to close out the retiree group and sort of lock in that cost, as opposed to holding on to that group for 18 months, waiting for an IRS determination letter and having to hedge the portfolio and ultimately not knowing exactly what that cost might come in at 18 months down the road. So there's lots of different strategies that can be employed here. I don't think there's any one solution that's right or wrong for any one sponsor, but a great question nonetheless. So now moving right along here to some settlement cost scenarios. This is our second sort of analytical slide, and there's a lot going on here, so hopefully I can do this slide justice and navigate the discussion effectively. What we wanted to show here was a sample plan, and the sample plan's up in the corner. This is a $30 million liability pension plan where 50% of the obligation is owed to retirees, a quarter to term vesteds, and the other quarter to actives. And what we're showing here in the chart with the different blue bands is how different settlement options and election rates drive different cost outcomes. Okay, so we've talked about this in the previous slides, that ultimately it's a combination of annuities and lump sums and how those are elected that drive your ultimate cost. So we're showing 4 different scenarios here. The lightest blue box is offering everyone a lump sum, where virtually everyone elects to receive a lump sum, and that is by far your most cost-effective way to go. It's also probably your least practically feasible for a couple reasons. The first being that most plans have a fairly significant chunk of retiree obligations, and most retirees don't want a lump sum. They've been receiving monthly income. They want to continue receiving monthly income. They've budgeted around that monthly check. So generally speaking, you're not going to get a very high election rate if you go offer retirees a lump sum. The other issue that makes this somewhat impractical is you're probably not going to get 100% of your non-retireds to elect a lump sum, for the simple reason that people don't open mail. So you can send them an offer, but if you send 100 of them an offer, there's a pretty good chance that 10 of them aren't even going to open it. So there's this practical reality to the actual process is going to effectively be a combination of both lump sums and annuities, except in the event of 100% annuity, which we'll get into in a second. But let's move down to the next lightest blue band, where this is a little bit more of what we might expect to see in practice. And this is going out and buying annuities for all the retirees when companies want to settle and remove the obligation, offering non-retireds a lump sum settlement where 85% of those non-retireds actually elect the lump sum, but the remaining 15% either actively elect or default to an annuity. So in this scenario, you can run through the numbers, and it's the same percentages from the previous slide that are driving these calculations. That comes out at about 115% of the GAAP liability in terms of the total cost to close out the plan. A third scenario, which would be again our second darkest blue band as we move down, would be just going out and buying annuities for everyone. And this does add some incremental additional cost, but I think one of the benefits of this approach that maybe isn't intuitive is that an annuity purchase, if you're going to buy annuities for everyone, that's the option that provides the most plan sponsor control over the distribution process and the timing. So when sponsors make the decision to annuitize everyone, they remove themselves from having to effectively go through an election process and be beholden to participant elections. The last box here, the darkest blue, would be offering lump sums to everyone where there's effectively a very low election rate. We've introduced the added element of some anti-selection charges here, which can further increase costs. And in this scenario here, you actually have your least cost-effective option where total cost rises to 118% of the GAAP liability value. So the conclusions we've isolated over here on the left, and I think there's a couple. One is that election rates and demographics are going to ultimately drive the economics. This is a sample plan where we've made assumptions around what the liability looks like and what the election rates are. Every plan is going to be different. So this gives you a sense for how this stuff plays out, but any specific plan is going to be unique in terms of what their numbers might look like. I think the statutory lump sum rates versus the annuity rates can have an added impact when you look at how those operate, and the fact that lump sum rates are typically set a year in advance and fixed for the preceding year, which is a little bit different than how annuity rates work, and that they're more spot, kind of bond yields that are changing almost daily. with movements in the marketplace. So that's another factor that people need to think about. And then plan provisions. I think there are specific plan provisions in terms of benefit subsidies, cash balance crediting rates, that can influence election rates. And we've seen this happen, where there's generous provisions embedded within the pension plan design, and intelligent participants kind of understanding the value of those benefits, not necessarily rushing to take the cash because they understand the value of what's being provided to them in the accrued benefit. So lots of different stuff to think about here, and it looks like we may have another question coming through.
Yeah, we got another good one. Question is there a sweet spot in terms of what sort of annuity placements attract the most favorable annuity contract pricing?
Sweet spot for insurer pricing. Okay, so I would say first things first is that we do a lot of work in the marketplace trying to help clients sort of engage and evaluate insurer pricing. And we see costs, on any given deal, from carrier A to carrier B can range, 5 to 10%, depending on the deal, the carrier's appetite, the embedded risk within the plan, and the demographics. So there's a lot at stake here. But in terms of a sweet spot in the market, in terms of what kind of deals do insurers like, I would sort of caveat this by saying, I think the marketplace, the annuity marketplace, is certainly evolving. Over the last couple of years, we've seen some carriers exit the market. We think there's one or two new entrants who may be preparing to enter the market, which would be a good thing from a pricing and capacity perspective. But there's these emerging jumbo cases or larger opportunities that are starting to bubble into the market that are very much changing the supply and demand dynamic in the marketplace. So as I answer this question, it's from a historical perspective of the things that we've seen and done over the last 15 years, which admittedly are changing. So I'd say, generally speaking, my sense is that a $10 million case that has mostly retired lives within it is probably going to attract the largest group of bidders. And that, having a lot of folks bidding on the annuity contract is generally good for driving an aggressive price for your client. I'd say at 50 to 100 million, you start to get that's a nice size for some of the larger insurers that are in this marketplace looking to make their sales budgets, and that 50 to 100 might be where you might find your most aggressive pricing on a specific deal. As you start to get up into the multiple hundreds of millions and certainly into the billions, I think the pricing proposition and the deployment of capital becomes a little bit different, and it's harder for me to say with any confidence in terms of how one carrier or another carrier might look at those opportunities. So we'll have to wait and see how the market evolves, but 10 to 100 is probably the sweet spot for the insurance market. All right, let me see if I can advance the slide here. All right, settlement versus plan termination, the chicken or the egg. And I think we sort of hit on this in one of the earlier questions in terms of investigating settlements outside of a plan termination event. And let me just sort of throw out there that even though we think the market is reached a tipping point and that there's a lot of settlement activity on the horizon, certainly a lot is already underway in 2012. Settlements are still the exception rather than the rule. So I think it's important for us to throw that out there. I do believe that organizations are beginning to execute more strategic settlements. But on this slide, we're just sort of surfacing the fact that there are sort of two worldviews here. One is the classical view on the left, that it's really the plan termination event and decision that drives settlement activities. And this is the way most people see the world. This is the way a lot of consulting is delivered in the marketplace, and the way a lot of plan sponsors think about settlement. You know, it's a very simple, vanilla way to think about it, and I think that's what people really like about this worldview. It's fairly reactive, and it's sort of an all or nothing. So there's certainly some, I would argue, some cons to this approach. On the right-hand side here, we have the fact that, you know, multiple settlement event decisions can help facilitate a planned termination event. So we're starting to see this emerging view be put into practice as companies start to offer these lump sum cash out windows, as companies increasingly look to annuitize their retiree group out in front of a planned termination event. The thought process here is don't be all right or all wrong, sort of dip your toe into the market, try to diversify the settlement action, and that perhaps settlements are part of how you get to planned termination, as opposed to the flip side of that coin. I think from an annuitization perspective, you know, 2012 certainly witnessed some very notable transactions. GM actually made a decision to terminate their salaried pension plan program and effectively procure roughly $25 billion of a group annuity contract. And Verizon, more recently, I think a week or two ago, announced that it will be annuitizing $8.5 billion of retiree obligations within its salaried pension plan program. So collectively, those two deals represent more than a decade of total marketplace annuitizations in the terminal funding marketplace. So, you know, really transformational sort of stuff. Two iconic companies really taking decisive action in a challenging environment to kind of put some of these risks behind them. And I do think that there will be a trickle-down effect in the months and years ahead that starts to change the discussions that consulting firms have with their clients, that pension committees have with themselves, and you're going to see more focused attention on developing a plan to effectively execute settlements in the years ahead. That's not to say that the classical thinking, again, the left-hand side of this slide, the very simple vanilla, hey, you wait till you're in a position to terminate and then you go out and you settle everything, I think that will still continue to be a very tried and true way of thinking and acting. So I don't think that thought process is necessarily going away, but I do think you'll start to see more folks looking to be a little bit more dynamic in how they think about settlements.
Hey, Jay, will you do me a favor? Would you be able to provide some practical examples for our audience today of some situations where you executed settlements outside of the typical plan termination and distribution process?
Sure. Yeah, I think, you know, practical examples are always helpful to more tangible for folks. I think specifically, you know, from a Dietrich and Associates perspective, I can recall working with a large insurance company, property casualty insurer, that actually made the decision 4 or 5 years ago to annuitize their retiree and term vested population, and effectively streamline the pension plan program to really cover just an active-only population. I think, you know, historically, when companies have made those decisions, you know, looking backward, there were lots of companies that were doing it not only to streamline but also to unlock some accounting gains that maybe had built up within the plan. I think prospectively, I think we live in a different world where accounting isn't as much of a driver as it used to be. It's more about managing the downside. So I think the downside risk that these pension liabilities present to companies is increasingly something that people are thinking about. So I think as we move forward, companies that look to annuitize or even settle with lump sums will be doing it more from an investment perspective in terms of how it makes what's left behind a little bit easier to manage. Good question there, though. Okay, and here's the slide that we've been building to. We've alluded to this throughout the discussion that 2012 is fundamentally different than the years that have come before. And large companies are clearly taking action. You know, we got these company names just by really going on to P&I Online and looking at all the companies that have detailed in their SEC filings that they're taking these pension settlement actions. So I think the logical question that most people have is well, why is this happening now? Right? Rates are at historical lows. These pension plans are pretty significantly underfunded. This doesn't seem very intuitive to a lot of folks. So I think the best way for me to try to provide some perspective on that is to sort of bisect the discussion into sort of two sections. The first would be kind of some macro or more general drivers, and then we'll talk about some more micro or technical drivers. But at a general level, I think point one is that CFOs are becoming more educated and aware, and that goes a long way. Point two, I think there's emerging research and analysis that really supports the corporate finance value of eliminating pension debt, and that adding funding can be inefficient use of capital. So I think that's been really helpful in terms of moving the needle a little bit. Pension accounting is definitely less of a driver of decision making in 2012 than it was in 2002. So I think that's a net positive to people executing settlements. I think service providers are tweaking their businesses to support this discussion, and that's ultimately an important a part of kind of the decision-making ecosystem, that all the collective stakeholders sort of have a similar worldview and understanding of these different options. So I think that's another factor that we're starting to see. I think this webinar is kind of a testament to that. And I think five, I think ultimately companies want to go here. They want to move the obligation off their books, so that you're starting to see companies actually take action and move to where they want to get to. Flipping over to the more micro or technical drivers, I would say MAP 21 created some flexibility in terms of relieving some benefit restrictions and in lifting funding so that lump sums were not restricted as they might have otherwise been under PPA. I think in 2012 in particular, there's sort of an interest rate and mortality arbitrage at play. What I mean by that is when you look at the rates that are in effect, the lump sum rates for 2012 were likely set at the end of 2011, and given that rates precipitously fell throughout the first half of this year, companies are now cashing out at a rate that's significantly higher than the market spot rate. So that creates some efficiencies from a cost perspective if you're looking through a short-term lens. On the mortality side, there's kind of this looming update from the IRS on the statutory mortality table, something called Scale BB, a new generational mortality table reflecting improvements that will likely increase obligations 3 to 5% in a year or so, if and when that's made part of the regulation. So companies that can lump people out with kind of above market rates and the what may be an older mortality table, there's a bit of an arbitrage there that I think people see some value in. And the third point is expense savings. So you got term vesteds that have small benefits. The PBGC costs, if you capitalize those, can be material. So by cashing folks out, you can save some money on expenses. I think that's another driver that's pushing people to take action, to take some action on this front.
So we have a question coming through. We got a lot of questions coming through. One specifically in regards to this slide that I know is a common concern with a lot of people we're talking to these days is what factors do you see will help insurers provide adequate capacity as marketplace demand for annuities continues to grow?
Yeah, capacity. That comes up a lot. It's come up a lot in the last couple of years as folks have been preparing for and anticipating an increase in demand for annuity capacity. I would say, the thing that pops into my mind immediately is innovation, right? So whenever there's a shift in the market and there's both challenges and opportunities that stem from that shift, I think innovation takes over. And what will innovation mean for insurers and capacity? I think it means a couple things. I think you'll see new entrants into the market, so that will help stimulate capacity. I think we're starting to see the evolution of a capital market for longevity, which may provide increased flexibility for insurers in managing longevity risk through having a capital markets that can help efficiently shift the risk to the capital market. I think reinsurance and captives may have a role to play as well. But also I think, insurers will just shift their strategy and their focus. So, I think over the last 10, 15 years, variable annuities and long-term care have been big lines of business for insurers, that they put a lot of financial and human capital behind. In 2012, I think the solution set to insurers is starting to look fundamentally different than it did 10 years ago. So I think a lot of insurance companies will be evaluating market opportunities, looking at what's going on and perhaps seeing a natural deployment of capital into the pension market differently than they did years earlier. So I think, right now I don't see there being a capacity issue in the marketplace, but it's certainly something that there's the potential for there to be a capacity issue, and the market will need to adapt to meet demand. Best candidates for pension settlements. We thought this would be an interesting slide. Again, think about you and your clients here, in terms of which organizations fit in here. I would draw kind of a dotted line through the middle of this slide. Corporate, mature plans, non-union, hard frozen. Those are kind of the high-level things that make for a good candidate. But there's lots of plans that fall into that group. It's the final four that I think separate the men from the boys here. The companies that are really focused on sort of wrestling a settlement strategy to the ground. It's focused. It's, do you have financial flexibility? So do you have cash within the business? Do you have access to low-cost borrowing to maybe, on a tax-efficient basis, fund up the pension plan and dispose of it? Are you comfortable with the accounting? But really, are you just willing to invest the resources to analyze and execute? We've brought this slide into a point here, the green box at the bottom, that says, for the companies that are focused, that want to execute developing a DB exit strategy, at a certain point, you need to go out and get the lump sum costs and get the insurance company quotes to be able to have the precision needed to guide those decisions. That's going to require, interfacing with your actuary and with an annuity placement specialist in a way that's probably a little bit different than you work today. So I think there's certainly a lot of value in thinking about how and when to get those data points to put a plan in place. But I think the two key questions which companies and their advisors really need to solve for, again, if you're in the group of companies that want to figure this out, are what's our time horizon for holding on to this frozen pension plan? How long before we want to be done with it, and what's our budget? If you can't answer those two questions, I think you're probably not committed to developing an effective settlement strategy and exiting the liability. It's more of a hope and pray. Let's just continue to fund it and hope that things things going our way. We're going to speed up the presentation here in the interest of time a little bit. Next steps, recommendations. Again, wanted to bring the discussion into a point here that people could walk away and maybe bring some of this stuff into practice. Something as simple as really just discussing with the pension committee settlement, bringing this up within that formal decision-making and governing body. Data integrity. This one is pretty important because if you think about it, it's pretty difficult to settle without clean data. Hard to calculate lump sums, hard to mail out election forms, and really hard to price annuities. So data is pretty important. Evaluating and engaging service providers who can assist in developing a settlement strategy. I think this point is somewhat nuanced, but it requires sponsors to recognize that settlement support services are generally outside the scope of what they're currently being delivered by their pension consultants. So thinking about, how do I get those services? Who can provide them? Is an important step. I think the shameless plug at this point for Dietrich and Associates is, we're certainly ready, willing, and able to become a part of the team. We think it's important for sponsors to think about adding a pension risk transfer advisor to their service provider team in front of the termination and distribution process to be able to help guide these discussions. I would close out this slide with saying, hope is not a strategy. I think there's lots of companies that are hoping for rates to rise. They're hoping for assets to perform. But I think the four things on this slide are actually things that you can put into practice to try to get to a better place. Let's see, maybe we have time. Chris, do we have time for a question here?
Sure. Yeah, we can slide one in. We got a short one here. It says, what information is needed to conduct an initial pension risk transfer analysis?
Okay. I'd say, so in order to start to think about settlement cost with a little more of a point on it, there's sort of a couple ways to think about it. One would be from an initial kind of high-level assessment perspective. And I think we have lots of these interactions with clients that are sort of trying to investigate different strategies. And for that, it's typically kind of an actuarial evaluation, perhaps the liability cash flow streams. That gives us a good working foundation to start to do some analysis and guide some discussions. For plan sponsors that may be more committed to actually injecting capital and wanting to dispose of obligations sooner rather than later, we would recommend a more precise analysis. We'd probably need the actual pension plan census data and plan document to be able to actually engage the insurance company market, get those plan liabilities kind of into the transaction queue so that we can kind of bring that output back to the organization and really give them the benefit of real-time, precise numbers in terms of what they would be looking at to annuitize the obligations, some of which we know will need to be annuitized. And one of our last slides here, strategic monitoring of settlement cost environment. We're practical here, we're realists. We sort of understand that the current environment for many organizations is challenging, and many companies will feel content to kind of defer taking settlement action until rates rise, until funding improves, effectively looking to try to lock in at a lower cost, as simple as trying to save some money. So recognizing that timing is everything, many organizations, they may not be committed to investing the time and energy to precisely evaluate settlement costs. So in recognizing that, I think 15 or so months ago, we here at Dietrich developed something called the Pension Risk Transfer Index. And this is a monthly barometer of the affordability of annuitization. So, it's a high-level indication. It's not plan-specific, but it's designed so that as this index, the number, which on here is reflected as 81.33, as that number rises, settlements are becoming more attractive. So you can see this index is showing exactly what we all know right now, that settlement is expensive. We're at the lower end of the range. As the number goes up and down every month, it gives pension plan stakeholders a pulse on what the market conditions look like. It's pretty dynamically constructed. It's got 7 underlying components that kind of drive the index. I think one of the more interesting things about this index, there's other liability indexes that are out there, is that this index does look at funded status. So we're actually we're bringing the asset portfolio into the equation in terms of a plan sponsor's funding level and ability to afford to settle the obligation, which we think lines up well with how the market sort of works. So I think this index is a very useful reference point for pension plan stakeholders who, again, may be looking for a simple process for monitoring the market conditions, and this can be a really easy first step to improving plan governance and getting some data points around figuring out when to roll up your sleeves and take a more detailed dive into investigating settlement. When we rolled this out 15 months ago, in the last 15 months, this has been picked up by the media outlets in each of the last 15 months. And we have several companies where the corporate finance members of the pension committee have actually incorporated this index into their quarterly reporting. So this is something that CFOs, treasurers, controllers are looking at on a quarterly basis to start to get in tune with the settlement market, and so that they can sort of figure out when might be a more efficient time for them to roll up their sleeves and divert resources to effectively looking at executing some settlement activity.
Jay, where can they get their hands on this, the folks on the call?
Yeah, I think so the index, the easiest thing to do is reach out to us, send us an email. I believe there's an email address at the end of this presentation. It's info@dietrichassociates.com. Reach out to us. We'll get you on the monthly mailing list, and you should receive it every single month. It's on our website, so it's out there. It's readily available and available at no obligation to folks who understand what it is and how it can help them. We're at the Q&A part now, Chris, but we're bumping up right against the hour. So I know we've been tracking the questions that have been submitted that we haven't gotten to. I'll be going through those and actually reaching out to folks to provide answers offline. But I think I certainly appreciate everyone dialing in here today. Hope you found this to be a effective use of your time. I know our plan is to have some more webinars in the future on different related topics, so certainly stay tuned. And just a quick slide again on Dietrich and Associates. We've been in the pension settlement game for a really long time and have a bunch of great people and great processes that we employ to help clients effectively settle their pension benefit obligations. So, Chris, I'll let you close out, but thanks to everyone for attending.
Great. I just want to remind everybody to keep an eye out for our next webinar featuring a very hot topic these days, the K annuity, and the need for guaranteed income in today's marketplace inside DC plans. So on behalf of the team at Dietrich & Associates, and Jay and I, thank you so much for tuning in and have a great rest of the afternoon.